The Fed pivot and bond prices. Hi, everyone, and welcome to Ainslie Insights, brought to you by Ainslie Bullion, Ainslie Crypto, and the Gold and Silver Standard. Today, we welcome back Alex for the first time in 2025 to discuss what is going on in the bond market. Happy New Year, Alex, and how are you going today?
I am going very well, still on holidays, but happy to do this on my holiday because it's a
Look,
bit crazy.
we're very appreciative. You're actually phoning in from overseas too, so that's a big commitment, and we appreciate that today, particularly with what's been going on. We had lots of moves overnight because we've had the inflation potentially in the US come in slightly softer than expected, but I would argue pretty much dead on expectations. It's all over the place at the moment, so I'm being very keen to get you on to hear your take. You wrote the article specifically talking about bonds, and that's always a tricky one that people struggle to get their head around. But you noted that government bond issuance is pushing yields higher, so what people expect to earn on their debt. At the same time, we've got central banks dropping interest rates around the place. What's going on here?
So we've always spoken about how people, sorry, investors just have not been pricing in risk. So the governments have been spending like crazy, and long-term debt rates were quite often lower or similar sort of level to short-term rates. So back in September last year, when the Fed and every other central bank was getting in trouble for holding rates too high, they started lifting rates, dropping rates, everyone except for Australia, thinking that this would help mortgages and stimulate some of the housing economies, which are collapsing worldwide.
Hmm.
And it has had the opposite effect because people have become more fearful of inflation, and governments have gone on a debt party since. And so there's so much more government bonds to invest in. The interest rate is going up. And what the interest rate in the bond market actually does is it drops the price of the bond. So if you've invested $1 million into a bond at 5%, and it lifts to 7%, that $1 million may be $990,000. So it starts reducing the value of the bonds, the physical bonds.
Hmm. And that obviously is a problem for bond investors. So they're going to say, well, if the bonds are going down, I want a higher return. And then it becomes sort of a vicious cycle pushing those rates higher. You suggest specifically that the deficits and fiscal policy uncertainty, because we don't know what government's actually going to do, that's resulting in this spike in term premiums. And the term premium you're talking about is what people are expecting, that extra sort of premium they're demanding for holding this debt.
It's a risk premium. So it's what they're saying, if the government's issuing this much debt, surely there's a risk at some point that they might default. Or surely if they keep dropping rates, there's risks that inflation goes up, therefore there's a higher risk premium on that. So it's a multitude of things that price into the risk of it. And everyone's sitting there blaming the fact that Trump's coming in. But you've got the UK, the highest in 30 years. You've got Japan creeping up above 2%, which I don't think it's done in 20 years. Sorry, well over 2%. I think it's at 2.7. And you've got Germany as well. Everyone is climbing up, and they didn't just elect Trump. So this insinuation that this is all coming from Trump does not seem appropriate. It seems that people are finally starting to price in the fact that governments have issued too much debt, and there is a risk now that something could happen, or either inflation or default.
And that makes a lot of sense, because what you're really talking about there is spending beyond means. If you're a country and you're spending beyond means, eventually people figure that out. And I appreciate your point too. No one's going to, or it's very unfair to say, well, that was a Trump problem when he's not even in there to do that now. So yeah, that spending has continued, certainly under the last term. Like Trump's last term, he was very spendy, but that was also COVID. So we have to remember that.
Well,
But
he's also talking about cuts, and everyone's saying he's going to spend more than Biden. Like it's not weighing up the way I see, what they're saying.
yeah, and that's, I think that's quite fair. Um, Slightly different, but it's a different side of the same coin, really. This idea of the US dollar. So can we talk about that for a minute? You mentioned that the surging US dollar is driving currencies like the Aussie dollar to multi-year lows, and the Aussie dollar has been absolutely punished
Uh-huh.
over this last little bit of time. That's also pushing gold higher. There's lots of consequences from that. In your view, what are the implications of this longer term, if we continue to have a strong US dollar, does that play into this bond story? How does it play into global trade and the impact for individual investors?
All right. So if the US dollar continues to rise, inflation in other countries will continue to rise. So most commodities are priced in US dollars. So oil, for example, was sitting around $70 a barrel. It's now $80 a barrel in US terms. But the Aussie dollar's depreciated about 10%. So what is 80 is actually 90 in Australia. So we've got that extra bit of inflation coming through. So again, the strength in the US dollar is pushing inflation out. That being said, last time Trump got elected, the US dollar pushed up like it has today, like it has over the last couple of months, and then dropped. So, if the US wants to manufacture more and be stronger, and Trump and, his administration has acknowledged this, they can't continue to push up the US dollar. So it's like the markets are saying one thing and you've got the government signaling something else. And it's confusing the market, number one, but number two, it's pushing inflation out everywhere.
And we will see that, I imagine, come back at some point where it really starts to impact individuals, because that's probably my next question around. We know that mortgages, and really when we talk about interest rates, mortgages is where it hits home the most for the most people. They often depend on those long-term interest rates. And paradoxically, if you've got the Fed cutting rates while those yields are at highs, it's kind of creating a situation that's going to push the yields up a little bit higher. If we've got a disconnect going on here, what's going to happen?
It's pushing the risk premium up, which is interesting. Yes. So paradoxically, they're trying to drop. They either cause inflation and continue to drop, or they lift rates and the long-term rates now lift because people are going to have to price in more risk premium at this point in time. So at this point in time, it looks like rates will continue to rise. What is interesting is you talk about individuals being affected. Look at the insurance market. They buy a lot of bonds. Look at what's just happened in California. They've just, they're estimating $150 billion in damage. And if they are selling bonds that they bought for insurance at a loss, it is going to create much higher premiums in things like insurance. It's going to cause banking losses and the collapse of those US banks that happened in 2022. There's a lot of implications with what's going on. Pretty much, I think 2022, the US 10-year hit around 5%, and that's when everything started collapsing. We're really close to that now.
We're right back there. Yeah,
we're right back where we were. So, when the Fed started dropping in September last year, their spot rate was at 4.5%, and US 10-year, their spot was at 5.3 and the 10-year was at 3.6. Now they're at a spot of about 4.5 with long-term at 4.8. So it is like rapidly increasing despite the fact that they're decreasing, and it is going to rattle the markets like it did in 2022.
And that I can see that just on the horizon, the potential for a real shakeout of those markets on the back of concern building. And it might take a little bit longer. It might be a 20, like I feel it's going to be a 2025 story somewhere. Like it might not be in the next month, but it could be. And it also could be one that's definitely going to build as the year goes on, because at the end of the day, the bond market getting rattled is what throws everything off. That's what is a wrecking ball that destroys the rest of the economy in that environment. So that probably leads me to my last question. You've even got central banks thinking about gold as a hedge here. We've talked about this for a long time. We saw it in China. We saw, like last year, a massive buyer of gold to balance out the issues that they were having. Maybe they're a bit of a front running, a bit of a warning of what was to come for us in the West. But what do you think's fueling that? Ultimately, do they foresee gold and other hard assets potentially continuing to gain favor because they are concerned themselves about their debt burdens? What's the link there?
Not necessarily sure it's them being worried about their debt burdens, possibly. I think there's more concern that there's been so much volatility in the US 10-year, 20-year bond markets, which is what most central banks hold as a reserve, and they would have all lost billions of dollars. Like everyone, I mean, look at the Fed, they were buying it. They've lost billions of dollars. I think they're like 50 billion, 100 billion, something outrageous that just the Fed in the US has lost. So these central banks are saying this is not a stable reserve currency and they've stopped buying bonds as much. So what are the other options? Well, there's crypto, and there's obviously been, looks like there'll be some adoption of that more out of the US. You've had El Salvador obviously adopt it, but it's not widely adopted. So what are they all looking at the moment? They're probably all looking at gold again. So they're certainly just not buying the bonds.
Look, all of that makes so much sense. I'll end with one little question that we can ask at the start of the year. What's your prediction then with that background? We end the year higher. Is that the prediction, or does it depend on
gold?
With gold,
higher?
do we end the year higher, or does it depend on what plays out here with this debt situation over 2025?
It's whether or not all assets drop relative to the US dollar strengthening, which can often happen. And if that is the case, gold will probably not drop, but not rise hugely. But if it is adopted strongly, then it rises. The issue is, I think, is the Aussie dollar is what's driven Aussie gold recently. I believe if the Aussie dollar starts rising, gold starts rising, because that's a weakening US dollar, which usually strengthens gold. So gold in Aussie, I would suggest, is strong.
Looking pretty good.
Looking pretty good.
Looking pretty good for 2025. That's Alex's prediction. That's what I'm saying.
We will see what happens with the rest of the world and what this bond market blows up in the meantime. Everyone is starting to focus inwards. It'll be a nationalist focus this year. That is it. Everyone, I was reading yesterday that you've got all the tech guys not going to Davos this year. They're all staying around for Trump. Like everyone is doing things for their country, not for the greater good of the world, and that has potential to blow up a whole heap of systems.
Look, we're living in a very interesting year, and we're very grateful to have you on board to help us navigate that as 2025 progresses. But thank you so much, Alex. Thanks for dropping in on your holiday, taking the time out. Really appreciate it.
Thanks for having me.
Thanks everyone for watching. We'll chat again soon.